Hey, hello friends, welcome. Hope all of you are doing good. If you are new, please consider subscribing to the channel and do like the video for YouTube propagation. Today I'm going to talk about trading basics and I'm going to give you some trading tips going forward. We are going to distribute this session into three parts because it's kind of a 30-minute long video. So I wanted to make it into three parts, 10 minutes each. Before I can give you any kind of tips, you need to understand the basics of trading. What is trading? So when we are talking of trading, I'm only talking of the stock market. I'm not talking of the commodity market. We'll make a separate series for that. When it comes to trading, trading can be divided into two parts. First part is systematic trading. Second part is discretionary trading. What is systematic trading? Systematic trading is something which is rule based, which has certain control mechanisms, which can be even automated to some extent using computers. This trading activity is done by institutional investors. So imagine this, you are a AMC, which is asset management company, and you are handling, let's say, $10 billion. So you cannot just randomly go and select stocks on your own, right? You have to have certain rules, certain control mechanisms, and certain set of principles that follow your investing strategy. You cannot just wake up in the morning and say that, okay, I'll buy this stock, I'll wait for 10 days, and then probably next day I'll buy the other stock and wait for 20 days. That does not work that way with other person's money, right? So when institutional investors do tend to do this systematic trading, it's very important for us to understand what is it. To give you an analogy, you must have heard of casino, right? Where people go and play a lottery. In that context, if you have seen the roulette wheel, you know that it's a wheel containing numbers. If you observe closely, what are your chances of getting either black or a red number? The answer is very easy, 50-50. Have you ever thought that how does a casino really make money? Because if you think about it, they always say that house always wins, right? But how does it apply to your investing? So whenever you're going into the casino, you're placing some bet. And let's say if you win $1 million, how will that sustain the casino business? It's a business. They have to run it in a systematic way and make it profitable, right? So how does it actually work? Coming back to our roulette wheel example, the probability of you winning is 50-50. But as soon as you introduce the third color, which is green, now the probability reduces to 47. In American roulette, your probability reduces to 47.37%. This difference of 2.63% is where the casino is earning money. So on each transaction, they earn, the probability of them earning is 2.63%. And in the long run, if you add them up together, it becomes huge. That's how the casinos earn money. Systematic trading is just this. You're applying certain set of rules, certain set of principles, and certain control mechanisms to govern the execution of trades. You look at your statement not every day, not every month, probably every quarter. This is exactly how the institutional investors do make a profit. Comparing it to the casino example that we saw, the 2.63% that the casino is earning on probability is the exact same percent that these institutional investors earn in the long run. So they come with a game plan. They are not trading 1 day, 2 day. They are going for the long run, let's say 20 years. Imagine you investing 1 lakh rupees and getting out, let's say 65 lakh rupees after 20 years. But this is how, in this process, you have made a loss as well as you have made a profit. But your profit percentage is slightly higher than the percentage of loss you have made, which is just the difference, that is 2.63%. And that's how they manage trading. The second type of trading is called discretionary trading. So basically in this type of trading, there are no rules to this. Tomorrow you pick up a stock, and it's not a rule that you will sell it tomorrow or day after tomorrow. You keep it for a random period of time. You sell it when you're getting profit. So there are rules, but there are no set of rules or mechanical rules that you need to follow. You can extend your profit or you can little bit extend your losses. In systematic trading, it's not that. As soon as you incur certain loss, you're out. As soon as you incur certain profit, you're out. So it's very systematic, very mechanical. The third type of trading which I do is hybrid trading. So in the hybrid model, I'm taking a few good points from the systematic trading approach. I'm taking a few good points from the discretionary, which is, trade at your will kind of approach, combining these two together and then forming or using these two together in my own strategy and then trading according to what I call it as a hybrid strategy. In discretionary trading, there are two approaches how to, pick a stock for trading. The first approach is basically source based trading, where you're completely dependent on a source, which can be TV, which can be news from someone, or which can be some agency or some broker that gives you advice, etc. So a source. Second type of trading is called technical analysis and fundamental analysis. This is the type where you do your own research, you do your own technical chart reading, and then based on this, you invest in that stock. And third type, again my favorite, hybrid of these two. You take a source, listen to them, you do your own analysis on that, and then invest. Take some good points from systematic trading, take some good points from discretionary trading, and then apply these principles to your trading strategy. So you can build your own trading strategy. Now, in this video, since I have just given you a brief about types of trading, I'll briefly touch upon a few aspects of do's and don'ts. Since I'm going to break this video into three parts, right, or three sections, this is the first part. So let's go step by step. The very first point that you need to understand are certain terminologies, something called as CMP, SL, DMA, or TP. What are these? CMP stands for current market price. DMA stands for daily moving average. TP stands for target price. SL stands for stop loss. SLTP stands for stop loss trigger price. You might have heard people using these terminologies, and that's why it is important for you to understand whenever people use this, you need to know what they're talking about. When I say I bought a stock at CMP 1000 and I had a TP of 1050, but my SL was 800, you got a pretty clear picture that I bought a stock for 1000 rupees. My target price for that stock was 1050 and I had a stop loss of 800 rupees. As simple as that. The second point, now you can consider this as a tip. Write down whatever you're buying. Make it a habit of writing it down, the name of your stock, the price that you bought it for, the CMP, your target price, right? So make columns, write down the stocks. So if you have bought 5 stocks today, write them down. 1, 2, 3, 4, 5. Write down the name of the stock, write down the CMP, write down the TP, which is target price, and write down the SL, which is stop loss. Make that column of SL bold letters. That is the price you want to exit on, right? So make it bold. The third tip that I want to give you is keep your gut out of trading. Don't be emotional in trading. And when I say keep your gut out, that means if you're having a feeling that no, today this stock is going to go up, just keep it out. Very important to keep your gut out of the trading environment. Fourth point that I wanted to cover is basically again a tip from my side, which is based on day trading. From personal experience, I would advise you not to involve yourself in day trading. It's very risky. Some people do day trading, but I feel that you don't have enough control over that share to, you have limited control. You have only days control over that share, which makes it very, very risky. So from my personal opinion, I would not advise anyone to do day trading. Fifth and the most important point in trading, I think every trader knows this. You have to have a SL, stop loss. Without a stop loss, don't even think about doing any kind of trading activity. It's very, very important that you have a stop loss on each of your transactions. All right, so I'll stop here for this video. I'm going to cover about technical analysis and chart reading in the next video, along with one example where I will try to give you my strategy, that is the hybrid strategy that I was talking about, where how to apply a stop loss, where to apply a stop loss, at how much percent, how much percent do you need to earn and then exit. So kind of a systematic trading approach, right? Combined together with discretionary approach. All these points I'll cover in the next video. With that said, I thank you all for watching. Do leave your thoughts in the comment section. Until next time, start early, invest now. Cheers.